Does this look to you, as someone who's been in the investment industry for so long, as a catalyst for some international diversification and moving away from US stocks? Because it's showing early signs of, the first outperformance, we'll say, by international stocks over US stocks since 2008, 2009.
You just hit the nail on the head that we have seen sort of that rotation into whether it's Europe or increasingly China and some emerging markets, whereas the last decade has really been dominated by the American market. And I think that is, as we've discussed ad nauseum, sort of the reality of the pivot away from the classic deregulatory tax cutting agenda to the realities that we're facing, which is a combination of international uncertainty vis-a-vis tariffs, and domestic uncertainty vis-a-vis DOGE and the incredible amount of cuts that we're making domestically to government spending programs, which have a huge component of GDP. So the combination of those two things is really sort of, again, going back to our previous analogy, sort of shaking the proverbial economic table here, which is making all of those things really challenging.
Every week, I'm delighted to see more people join Stock Club, especially because we've set a goal to double our podcast audience by the end of 2025. If you like our show and you want to support what we do, the best way is to click the subscribe button below. In exchange, I promise we'll keep bringing you researched market insights, detailed stock pitches, chats, laughs, and lengthy descriptions of graphs, which everybody loves. Thank you. Let's get on with the show.
Hello and welcome to Stock Club. Joining me on today's show, we got a very special guest. It's Taylor Krystkowiak. He's the VP and investment strategist at Themes ETFs. He's over a decade of experience within asset management and investment analysis across a number of companies on Wall Street, and he leads the publication and presentation of macroeconomic and macro research there at Themes ETF. He's got an undergraduate and master's degree in economics and finance from Harvard University, which shows he might be a bit more educated than our normal podcast guests, including myself there. His previous experience as vice president of product management at CBOE, and he was also an investment strategy analyst at Raymond James. Taylor, very welcome to Stock Club. It's great to have you on. Did I miss anything there?
Not at all. Thank you very much for the warm introduction. You've set the bar very high. It's a pleasure to be here, and thank you for having me.
Perfect. All right. Well, can you just kick off the show? Just give us our listeners a little bit of insight into your background and what you're doing now, especially at Themes ETFs.
Absolutely. I think you covered most of the highlights. Right now, we're at a shop, as the name would imply. Themes ETFs is primarily focused on thematic investments. So everything from artificial intelligence, cybersecurity, to big banks and uranium and nuclear. So it really sort of runs the gamut of all kinds of thematic funds. And one of the focuses that we've done in our business is trying to reduce the fee that we're offering each one of those thematic exposures at. And my role, as you mentioned, is really focusing on the global macroeconomic environment and seeing where those themes fit into the broader market and macroeconomic story.
Okay. And so I suppose it's a very interesting time to have you on. So you are the head of macro at Themes. Just like kind of 5,000 feet helicopter view on the US economy right now, because we're looking at a lot of political instability, a lot of question marks, and just uncertainty in general, consumer confidence, investor confidence. It's all really taken a hit in a very short space of time. So the last all-time high for the S&P was, I think, February 19th. There's a very sharp correction since there, we'll call it.
Absolutely. And as you mentioned, you hit the word of really the year, I think, is uncertainty. And that is certainly what the new administration in Washington has brought in droves. And one of the things I think you can think about this scenario is, pick whichever mixed metaphor you'd like. But really, the U.S. economy was a pretty sound Jenga tower leading into this year. And right now, we are not only whacking blocks out of the bottom, but shaking the table pretty viscerally. So between the tariffs that are coming down the pipeline, those that have already been announced, and I know that we are recording this right in anticipation of what has been dubbed Liberation Day. April 2nd.
That's a very common theme on this podcast, Taylor. Unfortunately, we tend to record right before something big happens and kind of guess what happens after.
That's exactly right. So we'll see, how much of what we discussed today will ultimately be relevant as we know. But, to your point, it's sort of hard to stay ahead of these because it's really by the tweet, by the minute, things really change on a dime in this environment. And so all of that foments what you, again, accurately described as high uncertainty. And that's really where this environment has left both investors and the economy as a whole is in a tremendous amount of uncertainty as to where we go from here. With a moving target of tariffs, it's increasingly unclear as to where the next target of tariffs is going to be. And as a result, it makes it very difficult to lay out some of those long-term investments. Something that I think would take that sort of nebulous statement and make it much more direct. We were talking about uranium and nuclear, for example. We get in the US about a quarter of the nuclear fuel, the uranium fuel that fuels nuclear reactors from Canada. And as a result of those 10% tariffs that just went into effect, they've actually reduced their inputs from Canada by about half. And it's really distorting the long-term picture for some of those nuclear investments, which we know have very long lead and lag time. So as a result of this uncertainty, it's really putting a lot of people are putting brakes on longer term projects to see where the chips may fall. And all of that is culminating into a degree of uncertainty that's putting a bit of a dark cloud over both the US specifically and then the global economy as a whole. And we've really seen that divergence from what was dubbed previously as American exceptionalism to now it's falling back relative to its global peers. Again, as you mentioned, the S&P has taken a very sharp turn. We're revisiting lows that we had prior to the election cycle. So there is a lot of open questions as to where we go from here and ultimately how things are going to unfold, given the fact that there is so much uncertainty in the air.
Yeah, the uranium topic as well. It doesn't help that China and Russia are the other two main producers of refined uranium as well. They're not exactly number one on the trading partners list. So I know this is impossible to predict, but we have seen somewhat of a kind of Trump trade war in 2018, which ended up being a very contained event stock market wise. Now, I know that was kind of solely focused on China compared to it's much more expansive now. And I'm really putting you on the spot, but do you see in your kind of immediate reaction, what do you think will be a long lasting impact of these tariffs, if any?
So I think we're seeing it unfold firsthand, and I think it's important to draw the distinction and the dichotomy between Trump 1.0 back in 2018 and Trump 2.0 now. And I think we can all agree that the tone and tenor and overall tact of these tariffs are very different now than they were then. Purely just on their scope and scale. And between whether it's the domestic agenda or the international agenda, it's very clear that Trump is approaching both the domestic and international with much more of a chip on his shoulder than he did in his first term. I think the genesis of the tariffs in the first term, and a lot of those I think were generally agreed upon. You saw some bipartisan support and even some international support for targeting China specifically. So there's a lot to unpack there, and I'd love the opportunity to sort of back up in the history of trade agreements and whatnot, because I think there's a lot of that nuance that's lost in these sorts of discussions. There's a lot of rampant misconceptions, and there's a lot that I think can be clarified with the benefit of a little bit of history and economics 101. But suffice to say, Trump 1.0 was really focused on sort of remedying and sort of balancing the scales, particularly as it came to intellectual property theft. That was one of the things, the accusation that China faced whenever U.S. companies or international companies were set to do business. Much of the terms of those agreements were revolved around sharing intellectual property or ownership inside of business, really in contrast to sort of the generally agreed upon principles in Western economic theory. So that was, I think, a lot of the flavor of Trump 1.0. And we had some additional tariffs that were levied against allies. And we had obviously renegotiation of NAFTA, became USMCA. But now in Trump 2.0, it's very clear that the scope and scale is sort of, it's open season. Everyone is sort of in the proverbial crosshairs here, and no one is excluded. Even, theoretically, our closest trading partner and closest ally through much of our history, Canada, north of the border. I think this is an example of one where really you see the Canadians sort of, digging in on this. And I think that's one of the things that Trump may not have fully appreciated in this calculus is how much this is actually playing into the hands of those politicians. Canada being, I think, a perfect and the best example of this. Whereas the Liberal government, Trudeau, were very much on the ropes. He had announced his sort of resignation, and it was, sort of a foregone conclusion that the Conservatives were poised to sort of pounce on that opportunity and take control of the government. But now, as a result of these tariffs, you see the Canadians and the incumbent party starting to actually entrench and latch onto this as a way to sort of coalesce support and some nationalistic fervor. And we've seen that also across the pond over in Europe as well. Macron, after having a bruising defeat in the French elections, is actually seeing a bit of a resurgence of the support. So this sort of American cudgel of tariffs that's being sort of wielded across the entire board is actually being used as a bit of a momentum to rally some support domestically in each one of these respective economies. So that's, I think, one of the big differences in the Trump 2.0 is, again, the scope, scale, and the fact that some economies are really digging in. They're not, throwing in the towel and saying, let's just make a deal. They are saying, no, we're going to stand up for our national sovereignty.
Yeah, absolutely. And that kind of digging in, yes, there's the political aspect to it, but there's also the economic aspect to it. And especially you've seen that in the EU. They've committed hundreds of billions in new infrastructure spending, a lot of it around defense, which I know in particular, Themes ETF has the NATO, it's under the ticker NATO. Is that correct?
That is correct.
Yeah, the NATO ETF, which is a kind of global collection of arms companies under the NATO countries. And I've seen a lot of inflows into that ETF in particular in this year. But in general, does this look to you, as someone who's been in the investment industry for so long, as a catalyst for some international diversification and moving away from US stocks? Because it's showing early signs of, the first outperformance, we'll say, by international stocks over US stocks since 2008, 2009. And that was typically a kind of a quite cyclical process where every few years international stocks would outperform, US stocks would outperform. And then there was this 15, 16-year period where US stocks absolutely dominated, and it kind of eclipsed the world stock market as a whole. I think it became almost 2/3 of the entire market cap was located in the US, and the US and the European Union at 2008 were around similar sizes. And economically. So do you think that could be a catalyst for investors to look further afield for investments, whereas it's been so easy for so long to just look at the US?
Absolutely. And I think you just hit the nail on the head that we have seen sort of that rotation into whether it's Europe or increasingly China and some emerging markets, whereas the last decade has really been dominated by the American market. As you mentioned, it's reached some pretty incredible proportions of the entire global market. And that wasn't for without cause. Obviously, America was the greatest sort of economic engine sort of powering that sort of performance. But we've sort of been caught in a confluence of circumstances, and which is why we're sort of seeing this play out the way it did. I think on the one hand, the market, I think, got a little ahead of itself in the wake of the election victory, right? So this is sort of the prototypical election rally on the heels of a conservative trifecta. Obviously, Trump won the presidency, and Republicans took both houses in Congress, both the Senate and the House. And generally speaking, the market was rallying on the prospects of a deregulatory agenda, tax breaks, all things that generally boded very well for markets and valuations, which is why we saw, sort of those multiples start to get stretched. And there was a, sort of a broad-based rally in the market, which I would argue probably took valuations, stretched them to their farthest extremes, to the point where you're almost priced to perfection, so to speak, and the risks remain to the downside. And then so we had, sort of that period from the election victory in the beginning of November to Inauguration Day in mid-January. And you can see sort of the market telling two very different stories. And you sort of right at Inauguration Day, as you mentioned, we've really sort of seen this precipitous decline, and the rest of the world actually rallying while the US market has declined. And I think that is, as we've discussed ad nauseum, sort of the reality of sort of a pivot away from the classic deregulatory tax cutting agenda to the realities that we're facing, which is a combination of international uncertainty vis-a-vis tariffs and domestic uncertainty vis-a-vis Doge and the incredible amount of cuts that we're making domestically to government spending programs, which have a huge component of not only GDP. I happen to live in the DC area, and the government is obviously a huge employer, and we're reading about tens of thousands, if not hundreds of thousands, of people being cut sort of arbitrarily by Doge, these sort of extensive cuts that Doge is making. So the combination of those two things is really sort of, again, going back to our previous analogy, sort of shaking the proverbial economic table here, which is making all of those things really challenging. Now, where are the opportunity sets? And sorry, going all the way back to the original part of that question about NATO, and I think this is one where I think most would concede that Trump was actually right. This was a big point of his in his first administration. Even Jamie Dimon has come out and said, Trump was right about this. And I think it was a combination of both sort of pressure from the U.S., but then obviously much more notably Russia's invasion of Ukraine in 2022, which really sparked off the reality that peace in Europe was no longer sort of a foregone conclusion. There was obviously this incredible period post World War II where, with few exceptions, there was peace in sort of the Western, the major Western spheres of influence. And as a result, I think there was sort of an ebbing of concentration on defense, and the U.S. sort of filled that gap. And so in Trump's first presidency, there was a lot of talk that said that everyone needs to sort of rise to the occasion. And then again, with the invasion of Ukraine by Russia, you saw that really, at that point, it kicked off a significant amount of spending by NATO allies. Now, most all in the alliance, the all-time high of 23 countries are going to meet that 2% of GDP target, spending 2% of their GDP on defense spending. And as a result, not only in the existential threat that Russia poses, and again, the pressure that Trump 2.0 is putting on European and NATO allies, we're seeing a lot of those defense stocks, particularly in the European market, rally. So I certainly think that this is a perfect illustrative example of, while there's again a tremendous amount of uncertainty, there are these pockets of opportunity, and NATO is a perfect thematic opportunity that is doing very, very well in this market. NATO up about 13%, while the S&P is down 5% so far year to date, as a nice illustrative example. So there's about an 18% performance gap just in the first quarter of 2025. So very long answer to that question, but I think gets at the sort of landscape that we're at and where you can find opportunity even in a turbulent market like this, perhaps more so. And this is where really you have to do your homework on the investment side, and this is where targeted exposures really are going to make all the difference, because broad-based benchmarks can't necessarily be relied upon in an environment like this when uncertainty is sort of taking out the bottom of the market across the board and is really weighing on those broad benchmark indices.
Yeah, and I think that's what we'll stay. We're talking about the major indexes, so the S&P 500, but the Nasdaq in particular, because we're discussing the current market rotation at the minute, and investors are selling off tech in a big way, especially the Magnificent Seven. So we talked about this last week on the episode of, as a collective, they're into a correction territory. I think Nasdaq actually this morning just went into a correction itself year to date. So where do you feel, or where have you seen where this money is going? So because it's coming out of those 7 stocks that have just powered the market for the last 2 years in particular. I think they're responsible for over 60% of the S&P 500's gains, and even more so on the Nasdaq side of things.
Much like the rotation out of the US into Europe and China, you're seeing domestically a rotation out of some of the high-flying growth names that had some, again, very stretched valuations. That's not to say that there's still a great investment case to be made long-term for some of these names. I don't think any of them are going away. NVIDIA is certainly not going away. Google's not going away. Microsoft's not going away. Apple's not going away. But it begs the question tactically whether or not this is the best time. And to your point, I think we're seeing that rotation out of some of those high-flying growth names more towards some defensive and value-based names. So, for example, there's another strategy we run. It's around companies that have high free cash flow. And that is a broad basket of large cap names that have a positive 3 years of positive cash flow growth. And what we've seen is that in those names, they've been rewarded for their quality. And that fund, for example, is up a little over 2%, while the S&P is down 5%. It's placing in the top 90th percentile amongst over 700 large cap ETFs. So I use that example to illustrate that there is definitely a rotation out of some of those names that have, again, multiples that are priced to perfection, and into names that are going to be much more defensively positioned. We use the cash flow example, I think, is one that's illustrative of a company that might weather this storm better than others. By definition, companies that kick off high free cash flow are going to be able to weather the exogenous shocks, whether that's higher tariffs. They can absorb some of those costs and because they have that cash flow buffer if they have to refinance, if ultimately rates stay stickier and they have to invest at higher rates and borrow at higher rates, they're ultimately going to be better positioned to weather some of those costs, and they're just much more defensively positioned. So all of that's to say, I think that's where the short answer is, that's where the money is going right now. That, and then also probably to short dated treasuries, just for people to wait out the storm. And then the final one, also, we're seeing all-time highs in gold, I think, as a proxy and as an illustrative example of that uncertainty. So gold hitting a fresh all-time high at the beginning of this week, $3,100 an ounce. And we've seen that reflected in our gold miners fund as well, ticker symbol AUMI. All of those gold mining companies, they're essentially getting pure profit on any dollar that's above $1,300 an ounce. So their market profitability is $13.45 an ounce. And as long as gold is north of that target, it's magnifying the margins of their profitability. And so obviously the higher that gold goes, the higher their profit margins. And we've seen that reflected in the performance of that fund. So I think in those three areas is where you're seeing a pivot towards defensive stocks, a pivot towards short dated treasuries, and a pivot towards precious metals, particularly gold.
I'm glad you mentioned gold, actually, because I saw you had, it's one of the best performing ETFs you have this year anyways, the AUMI ticker. And it's something we've probably never really talked. We are a stocks-based podcast. We're never really going to talk about gold, but I'd love to hear from your opinion, and someone with so much experience and studied finance for so long. Is gold a legitimate long-term holding, or is it only this kind of, is its purpose this defensive positioning for investors?
So I wrote at length about this, particularly contrasting it against some of the new sort of digital alternatives, particularly Bitcoin. And I think the conclusion has been gold will always be a unique case. Throughout all of our history, gold has always held this sort of exalted place as a store of value. It has sort of ingrained in our historical DNA at this point. So for that reason, it will always kind of have this special place, I think, in the pantheon of investment. So short answer is it's not going anywhere. And second answer is, and this is a perfect environment where when I think folks are faced with no necessarily great alternative, or they want to find a way to, a place to wait out the proverbial storm, you see everyone pile into gold. And I think gold will forever have that sort of unique place in the investment options for folks to sort of gravitate in times of uncertainty like the ones that we're seeing now. And I know that, again, you mentioned you're a stock podcast, which is great because we're also, we're a stock shop. We don't actually have a gold fund. Our fund is actually the gold miners. So the companies that are mining the metal and pulling it out of the ground. And what we've seen is actually those companies, as a result of this dynamic, they've actually had much more magnified returns relative to gold bullion. So they've actually had almost double the return of gold over the same time frame. So AUMI, for example, since inception, up well over 70%, almost double the same price appreciation that gold has had. And I think it's all going back to our conversation previously of how important valuations are and sort of the tactical entry point. Whereas gold is pushing all-time highs. So there's always the question is how much higher can it go? These gold miner stocks are not anywhere near their all-time highs. And actually on a valuation standpoint, they're still much, much more inexpensive than the S&P 500, for example. So they have a much, much lower price to book ratio. And you put all those variables together, they may have more room to run. And as a result, you're seeing them, sort of run higher on the upside than underlying bullion as a result. And when you factor in all of these, and again, as long as gold sort of stays above 1345 an ounce, and we're at 3100 an ounce, so there's a huge cushion there, and I think there's a world in which these gold miner stocks are going to continue to do very well. I think this is a great illustrative example of, if you're really doing your homework and you're seeing that there's sort of a tailwind in gold, this is an example of a strategy that's doing much better than even the underlying bullion. And if you're doing your homework, you crunch those valuation numbers, you can see that might have more upside than just piling into a gold bullion fund, for example.
Okay, and here's a hypothetical then, and I think this is the problem a lot of people will have when it comes to timing the market in such a way, is like, say if they do make the right decision, say if they got out of tech stocks in January and didn't feel right about the market, got into gold, they're doing very well. When do they flick the switch back on? When do they get back into equities? How would you advise, say, an investor who has done everything right so far? Because it's very tough to it's a two-part decision. You make the right decision first, but then you also have to make the right decision again and not miss out on the further gains from stocks down the line.
And, this is where the old adage comes true that time in the market is much more important than timing the market. Obviously, hindsight is always going to be 2020. There's always going to be room for, could I have called the absolute bottom? And what we can say as practitioners is that in practice, that is very, very difficult to do. So for your listeners on this podcast, my advice would certainly not be to try to time the bottom. And that unless you're one of the few magicians in this industry that really have the skill set and the tools and the insights to be able to really, dial in on that bottom. And even the greats of the greats have called it wrong. So that's not to say that these folks also...
Ray Dalio's predicted 16 of the last 3 recessions. You know what I mean?
and that was exactly who I was thinking of when I mentioned that. So make no mistake, even those who have incredible pedigrees, incredible history in the industry, they get it wrong too. So going back to the other part of that, which is time in the market. So I think there's always, this is sort of the tried and true method of dollar cost averaging it, right? You don't want to necessarily, put all of your dry powder in at any given moment, but you can certainly pick up pieces in increments. So whether that's buying on the way down, there's also, you don't want to necessarily try to catch a falling knife, but if you want at like you mentioned, whether it's at certain psychological levels, whether it's if you're a technical analyst and you're seeing some levels of support, sort of what we're bouncing around right now on the S&P, whether that's buying in at a chunk now and then, sort of seeing where the chips fall. If it falls further, being able to dollar cost average in further that way you're sort of having this sort of gradual approach to buying more, and you're sort of averaging your overall cost basis. And to your point, then this is where you certainly don't want to miss out on the upside, and that's where maybe shifting some of your relative allocations is a prudent opportunity. So if you're feeling nervous about the downside of the market, maybe hiding out in some of those defensive equity names, or being super defensive and hiding out in sort of those really short dated treasuries, or even sprinkling in some precious metal exposure, and using that and then as sort of the tides start to settle, pulling from that relative allocation and getting back into some of those growth names. But at the end of the day, it will all depend on your time horizon and your risk tolerance. Those two things cannot be emphasized enough, and this is certainly not meant to be advice for any individual, and that ultimately those two things are going to matter far more to your individual case, and then reconciling those against dollar cost averaging and making sure you have proper exposure that's consistent with your risk tolerance and your ultimate time horizon. Because I think the best way to illustrate this is to show both sides of that spectrum, which is if you're a very young investor and you have a lot of risk tolerance and you don't necessarily need access to these funds right away, you can afford to ride out the volatility. You can maybe pick up some of those growth names right now, continue to dollar cost average in them, and 5 to 10 years down the road, history has shown you're generally coming out ahead. But if you're sort of coming toward the end of whether it's your accumulation phase or you're sort of shifting to retirement where you might need to start drawing down on those funds, maybe getting into those highest growth names at this time is not necessarily the most prudent decision, and sort of staying on the more defensive side of the fence. So again, I illustrate those two examples as something that That's a long way of saying it's going to be unique to you and your individual circumstances.
Absolutely. And I think the last point you touched on was very prescient about if you're in wealth creation or wealth preservation stage as well, some strategies won't be very applicable. I would hate to see a 23-year-old who's just started out after college putting a lot of money into gold and short-term treasury bonds when they have a 40, 45-year investing horizon ahead of them. Okay, folks, this podcast is sponsored by Profit, my Wall Street's breakthrough new investing solution. Over 16 years of rigorous testing, Profit has never recorded a losing year, averaging an impressive 19.4% annual return. The best part, it just takes 5 minutes a month. No expertise required. We're going to invite all of our listeners of Stock Club to try Profit now, 100% free for 3 months with zero commitment. The link is in our description of this podcast, or just go to useprofit.com. That's PROPHET.com to start now and experience it for yourself. I'd like to touch on, because you mentioned volatility a lot there and the psychology around volatility. And I know you wrote a piece, I think when you were at Raymond James, called The Vicissitudes of Volatility. So it's fair to say you know your stuff here. But around behavioral psychology and how human emotion plays such a huge role in the swings and roundabouts of not only the market, but an individual investor's I suppose, investing journey. What can an individual do to counteract that? Because I know as a whole, it's impossible. It's like a person is smart, but people are stupid and irrational. And that's how it'll play out in the markets. But if there is a sense of fear and CNBC is just a wall of red arrows going down, how would an individual kind of preserve their emotions to a point they don't go and make mistakes based on their fear?
And as you mentioned, I think to a degree, it is impossible to avoid sort of the impact of volatility. And even the most stoic amongst us can ultimately become victims to our emotions. And I think that's one of the great areas of focus in our discipline. That's why you've seen sort of the recent Nobel laureates have been those in behavioral economics, because while a lot of these theorems that we've studied in school work well in a vacuum, and those in the Chicago school did very well, assuming everyone is a perfectly rational person, we're all computers that can have access to the same information, and the markets are perfectly efficient. As we well know, that is not true at all in practice. That works well in theory, and it completely falls apart in practice. And one of the things that we've realized is that by definition, the market is an inherently irrational, or it's subject to the same irrationalities that we humans are, just based on our psychology. It's sort of what makes us human. And when we're faced with the prospect of loss, sort of the wiring in our brains can short circuit. Even the most, again, the most disciplined and stoic amongst us, when you're staring down the barrel of, sort of double digit losses on your portfolio, it starts to rattle you. So the question that you posed, which is, how do you stay sane amongst it all? And again, that's where sort of going back to the basics, back to your time horizon. So one of the things that I wrote in that paper, there's a nice chart in there that shows that basically the longer that you're in the market, the less likely you ever face, a significant loss. There are very few times in history where over a 10-year cycle, you're ever going to, find yourself in the hole rather than ahead.
I think I've read a similar study, and it goes out in 20. There's like a 2% chance if you invested maybe at the peak of 1929, right before it crashed. That was like the only chance you could get over a 20-year period. In 30 years, it's not impossible. You would have never lost money over a 30-year period.
And then, the other one is that if you were the very, very unlucky investor that somehow invested all of your capital at the peak of 2000, and then, basically over almost a 15-year time period, you sort of almost got back to even in 2007, 2008. Then there was a great financial crisis, and then you really sort of didn't pop back. But that's only if you invested one chunk of capital and didn't touch it. Whereas,
this is where the statistics are so static, is that it's you can pick out the worst possible time, invest once and forget about it, instead of if you invested throughout 2001 or if you invested throughout 2008, you'd be looking back at them, in the four figures kind of percentage wise up already,
Exactly. And I think this is where we were speaking on a very abstract basis, but here's a great sort of, I think, concrete example of sort of that dollar cost averaging. And if you were buying incrementally through that entire period, you'd look back and wonder why you ever worried. So that's a long way of saying that, I think those who stay in the market are generally rewarded. Those who invest more in the market over a long period of time and stay disciplined are rewarded. And one of the big things that we've said, especially to those who are not watching markets on a daily basis and are not holding themselves out to be traders and trying to time things, that just set it and forget it. And one of the great wonders of the market is being able to put away money, generally speaking, in a low cost vehicle. That's one of the things that we, is in the DNA of our company. We've always believed that, the one thing you can count on is the drag of any fees on said investment. So if you can optimize the equation to reduce your fee drag, and you're consistently putting money in some of these strategies, that over the long haul, you're generally rewarded. So again, going back to the very sort of original question that you asked, which was, how do you stay calm in all this? You stay calm by looking at the numbers and going, on the other side of this in 5 years, you're going to wonder why you worried. And a lot of times, the other way that you can think about this is turning on its head. There's the Warren Buffett aphorism that says, I'd rather buy a wonderful company at a fair price than a fair company at a wonderful price. And Buffett, I think, is a sort of quintessential value investor. And you can look at this as, this is a fire sale on stocks. This is a discount. So when would you rather purchase a TV? Would you rather purchase it at a premium, or would you rather purchase it at a discount? And once you sort of apply that psychology, all of a sudden you can start to see opportunities in an environment like this, even while sort of you might feel that the sky is falling. The knowledge that ultimately you can pick some things up at lower valuations, and that's ultimately going to augur well for your upside. So generally speaking, history has shown, and the math proves, that it generally benefits you to buy on a red day than a green day. It's better to buy now than buying back in January when markets were sort of near all-time highs.
Okay. I got a few more general questions I want to throw at you. The first one, so you've worked at CBOE, and I just like your opinion in a general sense of how access to options trading from retail investors has, in your opinion, affected the markets over the last, say, 5 years.
Absolutely. And we worked, I worked specifically for sub-advisor of those funds. We were sort of the asset management arm. The full name of the company was SIBO Vest. As the name would suggest, most of our assets and most of our investment strategies were all focused on options. So short answer to your question is sort of the availability of options has certainly added a whole different element to the trading game, whereas options were really sort of the purview of the institutional and those who I think had the ability to really have these complex models, manage risk. We now have an ability for an average retail trader to throw open a Robinhood app and sort of have access to those options. So anyone who has, I'll be a little tongue in cheek in here, anyone who's taken a look at Wall Street Bets, for example, on Reddit, the very infamous subreddit there, you'd see how that soared. It's really, options are a way to magnify returns, either on the upside or the downside. So these are incredibly high risk investment vehicles. And I would say, as someone who has worked in that field, you really, really, really have to know what you're doing, and you have to know and do your homework, because unlike putting money in an index ETF, there's a way that you can really hurt yourself. To illustrate a far extreme, if you're sort of writing naked options, there is a potential where your loss is unlimited. So not only losing just what you put in, but then you're exposed to sort of infinite potential losses. That's sort of, again, a very extreme example. So that's a long way of saying that those approaching the option markets, especially on a retail basis, need to do so with an incredible degree of caution, need to know what they're doing. There are ways and approaches to options that are much more conservative than others. And there is always going to be a need to have a degree of respect for the fact that market is very different than just going long equities, long bonds. Options add a whole different level of complexity and a whole different level of risk. That being said, I've sort of led with all of the sort of concerns or pitfalls that may exist. On the flip side, options can also be incredible because they're a very useful tool. So, for example, if you happen to have a large position in a stock that you don't necessarily want to realize that gain, don't want to recognize tax consequences, but want to access some of the value there, you can cover call strategies, for example, that being one of the most I think well-known examples of using options to produce some income on an existing position, and ultimately being a conservative one because if those stocks get called away, you have it sort of accessible to you in the position that you already own. So as before with the, what do investors do in this environment? I caveat all of this by saying, work with a professional, particularly if you're considering options. This is where working with someone in the industry, whether that's a financial advisor or otherwise, can certainly help guide you through this. That being said, there is also an incredible amount of resources. And the other thing, if you want to sort of go it alone, there's also the paper trading route. So at least sort of cutting your teeth on what it might be like, practicing first before you ever start to do the real thing, because and then the final word of caution I'd say is that options, unlike a lot of other investment vehicles, especially if you're doing it yourself, I mean, one wrong input, one wrong digit, one wrong decimal, one wrong ticker symbol, those sorts, or if you're it's a call versus a put, if it's a sell versus a buy, if you don't put that order in right, it can have massive and catastrophic consequences. So,
blocks of 100 people, remember.
Yeah. So that would be my that would sort of be my comprehensive answer to the impact of options.
And then it's not options per se, but it's a very similar field, and it's becoming a new trend. It seems like a way of amplifying risk. Again, you're talking about amplifying returns or losses with options, is leveraged ETFs. And you've seen an awful lot of this with single stock leveraged ETFs. And I know Themes ETFs do it as well. So I'd like to hear your opinion on that. I know this isn't going to be like an attack, like say the 5x 5x MicroStrategy leveraged ETF or anything like that, which is just complete nuts. But how did these come about, and why have they become so popular?
So as you mentioned, I think the genesis of leveraged products is to satisfy the appetite and the demand for amplified returns. And that's ultimately been why these products came to market, why they've proven very popular, particularly in the retail investment crowd. I preface all of this by saying our parent company, Leverage Shares, as its name would imply, offers many of these leverage strategies. We've launched many leverage strategies here in the US. And as I mentioned, as their name implies, it's going to give you leverage on the upside and the downside. So again, these being sort of conducive more towards short-term tactical trading vehicles. So using this sort of example of, when do you pick up NVIDIA or Tesla or some of the other ones that have fallen from their recent highs, and you want to, apply a strategy that's going to give you a little bit of amplified return. Instead of you having to construct sort of the strategy that's going to give you those amplified returns, you can do so in an investment vehicle like this at a pretty reasonable cost, and then just get exposure 200% on the upside or the downside through an ETF vehicle that's going to do it for you. So it really takes out the guesswork and the danger, like I was saying earlier, about perhaps constructing the trade incorrectly, inputting something, because these ultimately are complex strategies and can be difficult for anyone trying to pull off on their first time, or even us practitioners trying to put on a trade if we're necessarily prone to the same errors if we're trading in our personal accounts versus trusting it to portfolio management professionals that do this day in and day out, have risk models constructed to sort of add some guardrails around this, and to make it ultimately a vehicle where you can feel confident that you're ultimately going to get that 200% return, and doing so at the trade-off there is doing so at a reasonable fee. So short answer to the question is, I think that those leverage funds ultimately give investors that access without necessarily the risk of assuming sort of constructing that strategy on their own, if that makes sense.
Yeah, it's a tightrope really in terms of democratizing finance in the stock market as a whole. Means you're not gatekeeping these investment vehicles that have so long only been held by institutions and all the rest, but also there's a reason why they were gatekept, because there's a high level of risk to them as well. And you know, in a perfect world, people would be able to use them, but they would use them safely and maybe not misuse them in certain cases, like the Wall Street bets is a perfect example. But yeah, there is there's a balancing act to be had there. Okay, I've got one more question for you, and this is just out of my own curiosity, and then I'm going to let you talk your book at Themes ETFs before we finish up. So I'm always so curious, and I don't know if I've ever had anyone on the show. So you studied economics and finance at Harvard, and then you went on to do a master's in finance at Harvard as well. Is that correct?
That is correct.
So what's it like? Do you know what I mean? What's your biggest takeaway from, say, studying at Harvard? Is there a sense of kind of being in a room with some of the smartest people in the world? Is there that kind of, does it look like it does on the movies? Do you know what I mean?
I approach this question with a bit of hat in hand, and I would say I'd like to start and say that generally speaking, we take all the same classes that everyone else does, whether at any other undergraduate program, any other graduate program. We're generally reading from the same textbooks. Maybe the difference is that our professor wrote the textbook, but at the end of the day, it may be the exact same textbook that's used nationwide. And ultimately, we take a lot of the same classes. So that would be the one thing I would say, is that regardless of sort of the connotation of the name or the pedigree, the denotation is we generally walked away with the exact same knowledge base, the exact same set of courses, the exact same degree that a lot of other folks did, and that there's again, accessing that level of education has, to borrow your earlier term, really been democratized across the board. And even Harvard has actually done a great job at sort of making a lot of these courses available. For example, its HBS core is now available online to many of the folks that want to access it. So going back to not gatekeeping education, not gatekeeping investments, this is, I think, a great illustrative example. And then to the other point of your question, which is the composition of the student body. And that's where I will say, being in a room with other folks that are smarter than you are is an incredible way to learn. So not only are you learning what's being taught in the classroom, you're learning from those around you. And one of the things I love more than anything is, at least in my degree program, many of my courses were taught by industry professionals. So my hedge funds course was taught by a hedge fund manager. And a lot of times you sort of run the risk of taking a lot of classes from, I don't mean this in a sort of derogatory, demeaning sense, but ivory tower academics that haven't really practiced in the real world. Whereas this program that I had, it was great to actually learn from people who had practiced in the industry, and you got a different sense. So I think I definitely appreciate the direction that a lot of these executive programs are going towards, having some more industry professionals teaching these classes, that it's not just straight academia, straight off PhDs. It's actually incorporating some folks that have sort of learned in the overall industry and brought their industry insights to the classroom. So that's sort of how I would answer that. As generally speaking, we're not all that different from anyone else who's taking the same courses, and we've been very lucky to have a great student body to learn from.
Yeah, if you're the smartest person in the room, you're in the wrong room. I say that's a rare occurrence in Harvard, anyways. Okay, so we finish out the show. I'm just going to let you talk your book a bit. You mentioned a couple of your themed ETFs already. We have AUMI is the gold miners ETF. We have NATO. Would you like to expand on anyone in particular, or I'll just kind of let you have carte blanche there to close out the show?
Oh, appreciate that. I won't take too much more time. I was going to go with 3, but we'll tack on AUMI as a 4th. So, sort of working backwards from performance, I would say AUMI, one of our best performing ETFs, again, up well over 70% since inception. Sort of the performance speaks for itself there. It's really leading the rest of the crowd on, sort of amongst the metal miner stocks. It's sort of a very niche, strategy for a lot of folks. But like I said, if you want sort of exposure to the gold trade, but perhaps want to do it with a bit more upside than gold bullion provides, for the reasons that we discussed, better valuations, a little bit more room to run, and sort of the buffer that they have. Basically, anything that's as long as gold is above $13.45 an ounce, these folks are doing real well in terms of their profit margin. And the higher gold goes, the more magnified their profit margins are. So I think that's sort of the investment case there. And then sort of segueing to one that we didn't talk about, but one that I think is really, illustrating its benefit in this market environment is our Global Systemically Important Banks Fund. Now, that's a mouthful, and really what that means in plain English is it's quite literally the too big to fail banks. And I know that that's sort of loaded language, but that is what global systemically important means, because essentially in the wake of the financial crisis, the world sort of regulatory heads got together and said, look, we need to identify these institutions that if they failed would pose a huge exogenous risk to the entire global economy. So as a result, those banks have had an incredible amount of regulation placed upon them. They have incredibly robust balance sheets, reserve requirements, and they have a incredible degree of quality sort of ballast in them. And we've seen that. So they've done very well through the sort of banking crisis that we saw unfold back in 2023 with Silicon Valley Bank, First Republic going under. And now we've also seen them sort of through this most recent bit of volatility. For example, GSIB, which is also the name of the fund, is up about 16%, while the market is down about 5%. So again, sort of illustrating its quality. It's last I checked was also the top performing financial ETF tracked by Bloomberg. So that's also another great one. If you're looking for a place to sort of hold out the big banks, could be a great place to do that, and are certainly not going away anytime soon, and can be a great place to sort of weather the storm of volatility. And then the last two names I'll mention, which we sort of discussed at length, NATO, as its name would imply, this is exposure to aerospace and defense companies. And the sort of different spin that we have on it is that instead of being 100% US based, like a lot of our US based competitors, this is about a 60% US, 40% international, primarily European tilt. So it has aerospace and defense companies that are headquartered in NATO member nations. And we've seen that strategy perform very well. It's about up about 13% year to date, again, whereas the S&P is down about 5%. And then finally, the one that we touched on briefly, if you're looking just for more of a generic large cap exposure, but one with some quality overlays, their large cap cash flow fund, ticker symbol LGCF. That one is, again, up about 2%, while the general market, as measured by the S&P, down about 5%, focusing on companies that have those high free cash flows, are ultimately going to be a little bit more insulated from the additional expenses that are going to be foisted upon them, either through tariffs, higher financing, and they're ultimately going to have that quality show through in times of volatility like this. So those would be the four main strategies that I would leave your viewers with today.
Okay, brilliant. Yeah, and it's kind of fits the whole conversation really of what we've been talking about too. Taylor, it's a pleasure having you on. Thank you very much for joining us, and thank you everyone for listening in. That's it for the show. We're going to talk to you next week.